of the morning, the story of the day has been UltraTech and its foray into the cables and wire space. That stock is down almost 6%, and that has taken the other cables and wire stocks down with it as well. Nigel is joining in with more on this. Nigel, good afternoon.
Well, that's right. That's the big story of the day. UltraTech has announced its foray into the cables and wires business, which has made the cables and wires sector itself very, very nervous. But let's tell you a little bit more about this. They're going to be putting around 1,800 crores over the next 2 years. By December 2026, they expect this, this unit in Gujarat, Bharuch, to in fact be up and running. So that's the commissioning date that they're talking about. The key reason is they're looking at extending their presence in the construction value chain. Now, why has UltraTech basically looked into the cables and wires business? A few factors out here. One is the business itself. The industry tailwind is there because the industry is growing at around 13-14%, as we have seen in the past. It's going to be moving from around 80,000 crore industry to around 1 lakh crore industry. Besides that, their raw material sourcing could be better because Hindalco is part of the group entity. So aluminium, copper as well could be made more available. The key reason they highlight, though, is they're focusing on strengthening its building products division. As of now, UltraTech Building Solutions already has 4,400 outlets. So they want to build onto that. Margin-wise, well, it will be relatively lower because we have seen that players in this space, they function at around 8 to around 12% approximately. So maybe a 10% margin is what you could work with. However, the ROC, currently on the cement business, they get roughly around 15% ROC. But in the cables and wires business, industry, most of those peers, they get around 25%. So margins could be relatively lower, but ROC will be higher. What is the concern then? Why is UltraTech down? The street is fearing the capital allocation wars, which wasn't the case now. They were only focusing on the core cement business. The other factor is, why couldn't they do it via Grasim? That's the other option they could have had. How do the numbers stack up? 1,800 crores is not big for a company that generates cash flows of more than 10,000 crores. As a percentage of the annual capex, well, it's less than 10% of that. And the revenue potential could be, given that normal asset turnover is around 4 to around 5 times, it could be roughly around 7 to around 8,000 crores with margins of low teens. Jeffrey says, yes, you could expect a knee-jerk reaction, but they have a buy rating out there. They say weakness should be used as a buying opportunity. For the time being, the street doesn't like capital allocation, that they have done right now. They would have preferred it to be in their core cement business, which explains why the stock is down by close to around 5.5%. Back to you.
Right, Nigel, thanks a lot for that. So that's one side of the story. UltraTech deciding to allocate 1,800 crores over the next couple of years towards cables and wires business. The street does not like the capital allocation out here, and that's why the stock is down 6%. But on the other hand, what this has done is set a flutter of, selling, or maybe, set the cat among pigeons in the cables and wires industry itself. So KEI industry is down 19%. You have Finolex down 6%. Look at some others, RR Kabel, all of them down in double digits. Havells itself in the morning was down by closer to 9%, though has recovered currently with a cut of just about 5.5–6% itself. Big disruption happening in this space. Has all the cables and wires segment investors worried? Are the companies as worried, and what the brokerages are making of it? Upasana joins in with the details of that one. Upasana.
Well, certainly, Mangalam, cable and wire segment is under pressure today as the street fears increasing competitive pressure with the entry of UltraTech Cement. Now, UltraTech Cement plans to enter wire and cable segment with an investment of 1,800 crore as highlighted earlier, as the company aims to meet the demand of growing cables and wires industry growth across the various sectors. Now, cable and wire industry has witnessed a revenue CAGR of nearly about 13% from FY19 to FY24. What the street fears is this entrance of UltraTech may intensify competition for the existing large players. Now, looking at the FY24 market share of the top players, Polycab stands at 26%, followed by KEI, which stands at 12%, followed by Havells, which stands around 11%. Now, brokerages like HSBC is of the view that this entrance is likely to have a material impact on the growth and margin trajectory beyond FY27 of these players. It has lowered the target price somewhere between 7 to 23% of all the major cable and wire key players. Coming to Havells first, the brokerage has given a buy rating with the target price cut nearly about 7% to 1,730 per share. Polycab, it has given a buy rating with a target price cut of nearly 20%, lowering the target price to 6,250. KI Industries, the brokerage has given a hold rating and the target price is cut as high as 23% to 3,450. And lastly, RR Kabel, it has given a buy rating and the target price of 1,260. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other housing players such as Finolex Cables and Havells, and Polycab continues to remain the key preferred pick for the brokerage. Now, coming to Morgan Stanley, it says that it is surprised with the move of UltraTech entering into the cables and wires segment, but it says it is not concerned about the industry play going forward with this entrance of UltraTech. So all in all, we are seeing all the stocks under pressure on the back of this competitive pressure.
Indeed, the street caught by surprise as well. And interestingly, they compare the FY25 multiples to their 5-year averages. Both Polycab and KEI are still trading above those multiples even after this correction. Where in fact, we spoke to Anil Gupta, the chairman and managing director at KEI Industries, to understand the impact of this foray. Listen into what he had to say.
This and the market space is big enough to give space to another player. Number one. Number two, UltraTech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me. So first, when we see from like margin point of view, first you need to see that it will take at least like 2 to 3 years to come into production, and again getting a sizable size of production and getting established in market. It may be another journey of 2 to 3 years. So it will altogether like 4 to 5 years minimum to take sizable size, even in this overall industry, which will be like around 1.5 lakhs by FY28 or 29.
Right, it's an interesting state of affairs right now when you look at the entire cables and wire space, Hormaz. Why is that? Because there were times when the markets are in a good bull run, any diversification from the core was something that was appreciated by the street. When we saw the entry into paint, so we saw entry into other things, the street was appreciating that because that meant newer markets. But now it means margin dilution, and as a result of which the street is a little worried about that. What's interesting is that UltraTech sees opportunity, but UltraTech analysts see capital allocation concerns. The incumbent players, they don't see any fear, but the shareholders of these incumbents, are worried about what those guys could do. So it's a very interesting space to be in right now, and most definitely we'll keep tracking this as we've been tracking the disruption that we saw in the paint space as well. So that was our Insight Edge special segment on halftime report in the cables and wires segment as UltraTech made its foray. With that, we'll step into a short break.